Hey there, welcome to Rein It In, episode number 45. My partner JG Francoeur is off fishing, taking a summer vacation, but the economic news does not stop. Canada continues to be in a free fall. So last week we talked about risk mitigation, and man, was it timely given what has taken place over the past 10 days since our last Rein It In. My gosh, the Canadian economy seems to be falling apart. As I'm doing this right now, just came off a weekend where the stock market crashed, the Japanese yen went south, and here we are today. Everything seems to be back to normal. Kind of. Let's talk about it. And remember, folks, just a polite nudge. Remember to subscribe, hit the bell notification, throw in some comments, definitely like. Let us know. So let's kick it off with a number of headlines, not the least of which is Canada's economy is tanking, but at least investors have options. Well, I'm not sure quite what the investors is, but as I read through this article, I went, you know, there's some really kind of poignant points that I think we have to pay attention to. Again, I come back to investing in real estate and looking at what's happening economically on both the US and Canadian side. And as I continue to say, real estate is still a play. You need to get your capital invested into assets, hard assets. Real estate remains that. But as investors, we have to look at what's going on in the underlying economy, stuff that we're not hearing about. This is finally an article that hits on some key points that I think we need to be aware of. So I'm sharing this particular page, and it leads with the Canadian economy is in some serious trouble if it stays on its current trajectory, as it has been the worst growth out of 50 developed economies since 2019, which flies in the face of what our government is saying. Now, I'm going to get a little political, but understand something. Forget about the politics of it. Underlying the politics is just really what is happening that we have to pay attention to. Again, our government is talking about how we're the strongest economy in the OECD, and we're just not. And this article goes on to say that this isn't a surprise because growth comes from capital investment, whether from Canadians directly or from foreign investors, and the environment here keeps getting less and less attractive. In other words, money is not coming into the country. Money is not into and investing in our real estate market as one example, but certainly even in our manufacturing and commodity market. Now, it goes on to say, well, government spending has nearly doubled to now account for almost half of our country's GDP. Bankruptcy filings here jumped 40% last year, and the Canadian Imperial Bank of Commerce said nearly half of Canadians have zero emergency savings. Now, we've talked about this in the past where we look at the demographic and the percentage of, let's say, middle or upper middle income into the very wealthy. That particular part or that particular sector of the economy seems to be doing okay. They have the cash, and although they're spending less and they don't have as much money, they're not struggling. You get into that bottom 60% of the overall demographic, and especially when you get into the service industry, it is just particularly getting slammed. It's getting hammered because of the cost of living. We go on to say that unfortunately, this is taking its toll on the Canadian dollar as well. So it's already fallen 13% against the US dollar since peaking in 2023, and is down to 72 cents. This means higher costs for goods imported from the United States. And keep in mind that Canada imported $277 billion worth of goods from the US in 2023. So when we look at what's happening there, the cost, again, we already know that manufacturing has slowed down. We know that construction has slowed down. We know a lot of things have slowed down already. Add to that the fact that our Canadian dollar has gotten weaker, 72 cents. And that means that companies are not investing in upgrades, for example, to production because of what they're paying for equipment coming in from the US. That's just one example. $277 billion worth of goods. That is going to slow down with a weaker dollar. Meanwhile, our government solution is to hire more government workers. Now, you've heard me shine a light on that multiple times. And over the past year alone, the sector has given approximately jobs to 180,000 workers, the public sector, which is more than the private sector and self-employed combined. Now, as you recall with the Bank of Canada, Carolyn Rogers came out and said,
we have an emergency, and that is our productivity is dropping.
And so, aside from the fact that the government continues to hire public service or the public sector, we have to keep in mind is that is an administrative role. Those roles do not support productivity, and that's the issue that we run into. And then on top of that, when we look at what's happening in the private sector, and we'll talk a little bit about that later, is that we're seeing insolvencies and actual bankruptcies in the business sector spike quite dramatically, which means they're not hiring, which also means they're not being productive. So you can see this downward spiral continues. So government workers is growing almost 4 times faster than the private sector. And that 1 in 3 Canadians now work for the government, and they make 30% more in salary and benefits than their private sector counterparts. Now, that is a button for me. I won't go into it. But again, let's just bring it back to what it means economically. And what it means economically is that things are going to continue to slow down. So on top of that, we have inflation. And it appears that inflation has been tamed, but St. I don't remember, I don't know how to pronounce his name, highlights that since the pandemic, Canada's official food inflation is up 25% and energy costs are over 30%, thanks in part to the carbon tax. And our citizens are now so overly taxed that it is impossible for them to get ahead. Now, what does this all mean? Now, we've shone a light on this many times over the past months of Rein It In, where we see inflation is slowing down. Again, when we look at CPI, it's a rate. Many talk about the cost, but it is actually a test or a statement of the speed of inflation. Now, speed of inflation has slowed down. And when you take out the shelter costs and the proportion of your mortgage being interest, it actually is less than 2%. So we're really anticipating the Bank of Canada lowering rates. One thing I've been 100% wrong on is, and I'm happy to be wrong, which was the Bank of Canada has in fact brought rate down a little bit, 1/4 point, and they expect another decrease. The market is saying there's going to be another decrease in September, as much as 50% basis point. Now, all of this is to say this. We've got inflation, but prices are not coming down. We go back to what I just said earlier, which is you got this cohort of individuals who are not in that upper income or even in the middle income range, and 60% of the population do not have discretionary income to spend. They're not going out, which again slows down the economy. Now, there's a point to be made here in all of this, which is that as rental housing providers, the cohort that we are actually providing for, as many are kind of higher income, that's becoming more common, $150,000, $180,000, $220,000 family income are now renting because they can't afford a house. The point is they can't afford to buy the house given the pricing these days. The point of it is this, is that we have to be very cautious about the tenant profile and the screening we do. I cannot stress enough is that is where the pressure is on. So we see a big demand for rental housing, but we also have to be really clear that the economy is slowing down. So the tenant profile, we have to be very, very cautious in terms of our screening and jobs, etc. Okay, so the problem is that the minimum income required to qualify for a mortgage on the average house in Canada is roughly $200,000. Now, that isn't the case if you go to Alberta. Now, a lot of these articles are driven out of Toronto, as in Ontario, GTA, surrounding area, and Vancouver. So we look at a roughly 200,000 is not the case in Alberta, not the case in Saskatchewan, not the case in Manitoba. When you look at the Western provinces and then some of the cities in outlying cities, for example, we're starting to see where the demand continues to be okay there. You're not having to make $200,000 to qualify for a mortgage. Now, the bad news in all of this, as this article goes on to say, is prices certainly don't appear to be getting cheaper. And when we look at it again, Look at Ontario, which is really where these articles get focused on. Nearly 200,000 people compared to only 36,000 home starts. So 200,000 people have moved into Ontario and only 36,000 home starts, which are largely one-bedroom studio condos and rental apartments. And that's according to Mike Moffat. So the point of it is that we continue to have this issue where immigration is strong, housing starts are not increasing. And if you get specifically into Toronto and the GTA, which we'll touch on, we have big problems in the condo market.
No, God, please, no, no, no.
So when we look at this immigration coming into the country, when we look at the economy slowing down, I'm going to talk a little bit about it as we hit on a couple of articles. But the point is, Canada's economy is in fact slowing down. The options that people have for investment remain in real estate if you are savvy. Other than that, people are trying to go to the stock market, get into some form of alternative investments, if you will. But again, we just came off the long weekend. And what happened? On Friday, the whole market melted down. It changed up again. People panicked. They got out. Now there's a huge call. We got to get the rates down. Whether that will happen in Canada or not, we don't know. Lots of pressure on the feds in the US. So it's a real mess out there. And ultimately, we think Canada will follow the lead of the feds. So we'll see what they do in September. Will the US drop rates? Bond market says yes. We're going to find out. But in the meantime, we still have to continue to do what we're doing, given the rates where they are today. So when we see articles like this, there's a lot of great information in this. So beyond the headline, when you unpack this, you start to see some of the details. But let me know what you think. I look at the highlights of this, and there's some real relevant data here that impacts some of our decisions. And when we start to create the thesis for how we're going to invest, we need to look at this data. Let me know what you think of this article. So next on the list of headlines that we got to pay attention to is why Toronto's stalled condo market will make the city's housing shortage even worse. Now, we've been talking about what's going on. The condo market in Toronto and parts of the GTA is absolutely melting down. All of these shoebox condos that have been built and the pre-built are all being problematic as they come online. People are not able to qualify for mortgages. They can't rent them out. They don't have the option to assign anymore. Nobody's buying assignments, even stuff that's discounted ridiculously. And a lot of people are just literally walking away from their down payment, which sounds easy. Not that it's easy to walk away that money, but of course, some developers are going after the buyer. So this is becoming a bigger and bigger mess by the week. But what's interesting about all of this, and what caught my attention on this, construction starts are trending less than 10,000 for the current year as developers abandon projects, but Toronto needs 30 to 40,000 a year to satisfy population growth. So the article goes on to say that when you look at the 30 to the 40,000 just to satisfy the population growth, 23,900 condos and purpose-built rentals are projected to be complete in the Greater Toronto and Hamilton area in 2027, a 10,000 unit decline from 2024. An urbanation project shows, and numbers will continue to spiral downwards. That 10,000 has recently been actually given an update, which is more like 7,500. So here's a couple of things that we have to pay attention to when we see this. Number one, we understand that, yes, this is interesting that eventually condo investors will come back around and we'll start to see things happen. Prices are coming off in a lot of those particular projects, if you will, or those in the condo market, but not a ton. They're going back to 2019, 2020 early, certainly not back to the all-time highs. Now, aside from all of that, when we look into the future, they see shortages given the population coming into Ontario, and our government doesn't seem to be tapping the brake on those immigration policies. Although they talk about it, it's not really happening. Here's the thing. Construction is all but stopped. There is no construction happening. Builders are literally shutting projects down. Many builders have gone and developers have gone broke. They're declaring bankruptcies. These are all bad news scenarios without question. And add to that the construction jobs. And man, we've been talking about this for 18 months. This construction job issue is going to be more problematic. We're going to start to see the unemployment, specifically in Ontario, start to tick up. Now, if you bought a pre-built, I don't even know what to say to support you in kind of getting out of the problem or having that issue. These are not good times for condo investors, no question about it. More money in is the only solution to that problem. But if you're in Ontario, it would be interesting to see and hear your perspective. As I talk to people who are in the trenches, they just shake their head. They're going, it is melting down. It's going to get far worse before it gets better. I also see the ripple effect of that, which is not just construction jobs, but we have to look at the jobs that support any given transaction. And that's from lawyers who are now being busy with bankruptcies more than they're being busy with transactions, perhaps. But it really is that whole sector starts to slow down because deals aren't being done. Not good news for Ontario. Now, we go back to what we've talked about also on top of this, and I just want to highlight it. This is the condo market. This doesn't speak to single family, small multis. That market continues to be high demand, but because the math doesn't pencil, not a lot of units getting built. As a matter of fact, we've said before that detached unit or even semi-detached are on the decline when it comes to building in Canada. So for us as investors, I keep linking it back to us. What does it mean to us? For me, from my perspective, what it means is demand will continue to be there. The hard asset called real estate, store value, and that asset will be appreciation given the demand isn't going away. So these are things to consider. Stay focused on the detached, semi-detached, single family, small multi-market, and you'll continue to do well. Hard to find those deals. I get it. Keep digging. The deals are there. I'm talking to investors almost weekly that are doing deals, finding great deals, because there is definitely some motivated vendors out there. So pay attention. Make sure you've got the right investor-focused realtor on your team. You'll do exceptionally well. Headlines like this are actually speaking to the desperation that we're seeing in Ontario. Builders now offering half-price mortgages, but there are still no takers. We're going to see more and more headlines about builders/developers offering incentives to potential buyers to take on units. Now, I'm going to just speak to one fundamental thing here without unpacking this. What they're really doing, or getting into too much detail, what they're actually doing is they're incentivizing through a reduced mortgage. So in other words, a mortgage rate, an interest rate. So they're actually picking up the slack on the interest rate. The banks, they're kind of working in the background. It takes a little bit of juggling. It's a little convoluted what they have to do given what the banks require to actually finance a particular deal. But let's just park that off to the side a little bit. What developers are now having, and because of the project that we're working on called the self-funding house, we've talked about it, where in fact, people are having to look at units, get what was referred to at one time as mortgage helper or house hacking. The self-funding house is really shining a light on what many developers are having to do, work with municipalities. That is part of what the self-funding house initiative is all about, which is to add units to housing so that people can actually afford.
Life moves pretty fast. You don't stop and look around once in a while, you could miss it.
So banks are giving 100% finance or 100% rental offset if you have a unit, an ADU, an additional dwelling unit in a property. You rent that out, they're giving you 100% rental offset. Now that's why we're excited about the self-funding house. And that's a bit of a shameless plug for that particular initiative that we've got going on. But it also speaks to what is going to start to happen more and more in the market, where we're seeing these builders and developers, in order to get rid of this inventory, to get it off their books, to actually get cash back in the bank, they're going to have to get creative, and we're going to see more and more headlines about offering deals on mortgages, offering deals and incentives on units to get them off their books. Now, there's another underlying challenge that we're starting to see and hear about more, and that is in Canada's banking system. Now, this all shines a light on the kind of the ripple effect, if you will, the domino effect, however you want to look at it. And ultimately, JG and I spoke about it, I think, 2 or 3 episodes ago, where banks need to lend money and people are not borrowing right now. We know that the real estate market is soft. We know that the real estate market makes up a huge part of Canada's economy. And we also know that banks need to lend capital. That's how they make money. We're starting to see a pullback in stock values of banks because it's a little bit nervous out there of what is happening with Canadian banks. So we're going to see more of these headlines. We're going to see more opportunities show up. This is something to investigate. My suggestion with some of these deals to just kick tires, go in and look and see where they are in the process. Can you add an ADU, an additional dwelling unit, to these particular deals? All to say this: opportunities don't just drop in your lap. Sometimes you have to go out and create them. And in a market like this, where everybody's scared, everybody's inspired, motivated to try and get rid of some inventory, I'm going to encourage you to consider kicking some tires with these developers, builders. Make a phone call, talk to these guys, see what you can do in terms of adding an ADU, because some of these units that they're talking about in this particular article are very appealing, and their offering and the incentive they're offering are also very appealing. So this is where an opportunity may get created. I'm not saying it can, but these are the kind of things that are going to start to show up where we as investors want to be able to jump in, take advantage of these opportunities in this kind of a marketplace. So it'll be interesting. I don't know what you think, but that's what I think. We often hear about and complain about the central banks, and in this case, Bank of Canada, but central banks in general always seem to raise rates too late. In other words, inflation gets away, we better raise rates, but they don't allow and account for the lag. So in other words, inflation is well on its way. So we saw that happen exactly when Bank of Canada had to read and react. Fastest and most increases in history as we tried to tame inflation. Now, as the economy has actually started to slow down, if you're in the trenches, you can see it. They're slowly decreasing rates because they're afraid of inflation getting ahead of them. Well, at the end of the day, we know that they're going to decrease rates. They're going to do it too late, the same as they were too late in increasing rates. And we're going to see and feel some economic pain. Some are calling for a recession as if we're not already in it. Again, it depends on where you are in the cohort of income earners. And the reality of it is that in many sectors, we are in fact in recession. Now, what does all that mean? So when you look at what the Bank of Canada is or is not doing, last Friday, we had what they called a market meltdown. And of course, by Monday, that market meltdown has upticked again. Some are calling it a dead cat bounce. We're about to see the equity market was really hard. The VIX, which measures the market sentiment, spiked. It went crazy. Now the Fed in the US is calling for an interest rate decrease. Bank of Canada is expected to follow, and BMO is on that train. BMO now expects cuts at each of the next 4 meetings, which would take the rate to 3.5% by January. The cycle could wrap up by mid-2025 at 3%, which is more than half a year earlier than expected, said Doug Porter, who's an economist for the Bank of Montreal. We know that rates are going to start to come down, and that's, again, what is the timing of all of this? We look at how slow they are in decreasing rates. From my perspective, I'm just happy they're decreasing rates. My call was that they would not and they may not decrease rates this year. And that was earlier on what I was seeing in the kind of economic data that was unfolding. So I'm not surprised that they're slow to do it. I'm actually, in some regards, surprised that they are even lowering rates. So it's all to say this, is that as investors, we can look at these rates coming down. This is, again, the time to look at some of the deals that we talked about before. But the Bank of Canada is going to be seen to be cutting rates. There are lots of pressure on the feds in the US. the Fed's lower rates, we know the Bank of Canada will ultimately follow suit because that is who they got to stay as much as they can. They got to stay aligned with what's happening in the US. I think we can look forward to a rate decrease in September. It's just a case of will it be a quarter point or it will be a full half basis point that they lower the rate. Time will tell. Having said all of that, we also see that bond yields have come down. So we're seeing fixed mortgage rates start to come down, improve a little bit. We're getting into the high fours in terms of what you can get for a fixed rate right now. Not so bad, relatively speaking. So we'll see what happens with this as it plays out. They're going to decrease slower than they should, perhaps, because what we're seeing in Ontario unfolding, and we're going to talk about that in just a minute, is bad news across the board economically. So let's see what the Bank of Canada is going to do in September. Hopefully they're going to reduce rates. So as the Bank of Canada sits on the sidelines, seemingly contemplating whether to bring rates down even further, we're seeing more headlines like this one, that more than 300 Canadian filings for bankruptcy each day as insolvency filings hit a 4-year high. So the Canadian Association of Insolvency and Restructuring Professionals report for the second quarter show a rise of 12.4% in insolvencies compared to the year prior. And the business numbers, or the numbers for businesses, are even worse, with insolvencies spike. In Ontario, the province which saw the greatest year-over-year bankruptcy increase with 13,309 filings, a rise of 18.3%. And in industries that are hurting the most are construction, transportation, and warehousing, as well as administrative and support and waste management. Now, this is all to say that goes back to what we said and what I pointed out even in the slowdown of the housing market overall, which is that construction jobs and the ripple effect of the other jobs that go to support. Now, housing has been for many years such a big part of Canada's economy. That's why we're going to start to feel this pain. The challenge that we've got is the lag. And the longer Bank of Canada holds off lowering rates, the more that lag is going to start to actually snowball. We're going to start to see those construction jobs and all the supportive jobs, again, when you look at transportation and warehousing, all part of that, by the way. And ultimately, we start to see that slow down, and we're going to continue to see some bankruptcies. Now, it seems to have slowed a little bit, but there'll be the next phase. The more important part of it for me when I look at job growth is the fact that SMEs, or so small, medium enterprises or businesses, are slowing down. They're filing for insolvencies, which means they're not hiring. They're just trying to keep their doors open and have the liquidity. So when we look at what's going on for the rest of 2024, we're going to continue to see these headlines. Again, what we haven't seen is the slowdown in the prices of real estate. We've seen buyers sit on the sidelines. We've seen listings go up, but we haven't seen prices come off. We've got immigration driving that part of the equation, if you will. So where will it all go? Again, we're going to come back to saying regionally, and then property type. Stay focused on these detached, semi-detached, single family, small family units. You'll do exceptionally well. And we know that interest rates will come down, given the fact that we've got this pain that's being felt in the market by both individual families and businesses. So keep your eye on that. I think we're going to start to see it. I would love nothing more than to trash our government, because it just really pushes my buttons that this is happening, and the Bank of Canada is being slow to lower rates. As investors, it gives us opportunity. So stay focused on these headlines, watch what starts to unfold. And I'm going to give you one other kind of piece of guidance, if you will. We talk about it all the time. Cash is king. Stay as liquid as possible so that you can actually step up and take advantage of some of the opportunities that we're going to continue to see unfold in the real estate market. This is where I always earn the reputation of Mr. Alberta. Again, I'm agnostic. We just look at what's happening in Alberta, and it continues to be a shining star amongst all of our provinces. And that is, by the way, not to negate the economic strength of both Saskatchewan and Manitoba within their housing market. Affordability, deals being done, cash flow, all of those things in both Saskatchewan and Manitoba are there. We don't talk a lot about it because ultimately we look at Alberta and we say, with what's going on economically right now, Alberta continues to be the place to invest. Now, we've qualified it, we've quantified it many times over now 5 years. We've been talking about what's going on in Alberta. I still am going to put some cautionary notes always about what's happening in Calgary. The market is into a kind of a boom cycle, and this is where mistakes get made. I'm going to caution you to make sure you're buying for cash flow, you're paying attention to property type, and you're looking into the future and watching what's happening, unfolding economically in Alberta. Okay, so let's take a look at what we've seen in the past few months, the past few years, actually, in oil production in Alberta. Year to date continues to rise. We're into record levels of oil production. Now, on the surface, some may be saying, okay, yeah, well, a classic Alberta boom bust cycle, oil's going to crash given the slowdown globally. I want to just point out something here is that I called for higher oil and I've been wrong, and I've been wrong for lots of reasons, but not the least of which is China data earlier this year was actually pretty robust. Now we're seeing is that China is slowing down. We're seeing what happens with all of the potential global World War IIIs. I mean, there's at least 3 or 4 scenarios unfolding right now. What is that going to do to oil? Well, it's going to slow the economy down, which then in fact means that the demand will decrease. We're seeing oil prices come down. I don't know. I keep looking at it and watching it, and I think oil is going to end up still being strong towards the end of the year. Depending on what happens with the wars, well, who knows how that's going to unfold. We look at what's happening in Iran and the fight between Iran, Israel, Lebanon is now in, Middle East. I mean, it's so convoluted. Why am I even ranting on this a little bit? Because it's going to have an impact on oil, which will have an impact on the Alberta economy. This is a cautionary note. Right now, oil production is record high. That could come off rather quickly depending on what's happening. All to say this is that we watch these and we look at what it means to Canada economically. And you can see here by these charts, if you look at the chart on the left, share of natural resources in Canadian nominal GDP, you see the huge spike since 2020. Of course, that's when we were shut down. But even go back to 2016. Here's the point that you should pay attention to. When we look at what happened in 2002, 13, 14, we saw this big spike up. And when we look at that big spike up, and then ultimately things slow down, and what we know happened in Alberta's economy back then, everything came to a screeching halt. So when we look at this big spike up, everybody's really optimistic. I'm shining a light on it, is that we could go back here, given what's happening in a global picture, especially given the potential for a World War III. Now, when we come over to here, the contribution to Canada's natural resources GDP in 2022, 38.2%, 23 and 24, although the data isn't in, anecdotally, the trend has continued. So all good news for Alberta right now, but when you start to see just how big a factor it is, not just in Alberta's economy, but in Canada's economy, we got to watch those oil prices, because in Alberta, if we follow a cycle, we have to know that things could pull off, which is all to say this: buy for cash flow, buy the right property. Demand continues to stay high as immigration floods into this country, and certainly because of affordability, continues to flood into Alberta. So in amongst the chaos, we'll continue to be cautious optimism and opportunity for real estate investors who are paying attention to the details. Now, speaking of Alberta, we often ask,
Why are insurance rates so high?
well, in your postal code, they may be high, and especially if you're in a postal code that annually gets hit by hail. Another hailstorm in Calgary over the past weekend, and damage was extensive. Cars trashed, windows trashed, siding trashed. So when we look at insurance and we say,
Well, I haven't even put in a claim.
what people forget is that insurance is now become, and this is a new phenomena, relatively new phenomena, you're insured and the cost of your insurance is literally by postal code. So when you look at the fires of Fort McMurray, the floods of southern Alberta, the hail damage consistently in Calgary, these postal codes are paying a premium because insurance companies are tired of paying out. Can you imagine the claims that are flooding in this week after a weekend of giant hail? You can see by this picture, some of this stuff is bigger than a golf ball, more like a hard ball, as in baseball. And these are the challenges that that particular postal code in Calgary face, because this is an annual event almost. So if you're wondering why insurance rates are there because you haven't put a claim in, well, you're paying for everybody's damage. And that's just the way the insurance rolls. So thanks for listening to Rein It In, episode number 45. When we look at all of the bad news out there, we have to consider that within the bad news lives the opportunity. Stay liquid, buy for cash flow, make sure you're looking at the right investment deals, take your time, surround yourself with the right team. There's no doubt that when we look at Canada's economy, there's still some discussion. Are we in a recession? Is it going to be a soft landing? Is it going to be a hard landing? However you create your thesis, understand that the decisions you make today have to play into that thesis. So if you see a hard landing, make sure that you're perhaps putting more money down on the deals. Make sure that you're buying the right property type. Think it through in terms of where you're investing your capital. Real estate is still a store of value. I can't stress that enough. Given monetary policy, given what's happening on an economic global scale, we need to get our capital out of traditional fiat currency and into what we would call a store of value. Hard assets. Real estate is one of those hard assets that we want to put our capital in, but we have to be responsible for it. How do I see the future? I think we're in for a hard landing. I think we're still maybe a year away from really feeling the effects, but ultimately over the next few months, we're going to start to see the unemployment continue to ramp up, even though Bank of Canada will lower rates. And if Bank of Canada literally walked in tomorrow and lowered rates 75 basis points, again, because of the lag, all of that takes time. So depending on where you are in your thesis, depending on where you are in your own investment journey, when we look and start to understand that rates will be coming down, we can look at the deals that we're doing and be fairly confident that if we're using rates that are, let's say, 50% or 50%, 50 basis points lower, how does that math look for us? I think that's a fairly safe bet. Some of you may be more aggressive and go, no, I see it coming down a full percentage point. Then base your thesis on that, whatever you do. Here's the thing about it all. We have to look into the future and say, I've got a long-term vision of my real estate portfolio. I'm looking 5, 7, 10 years down the road. And we just know that when we consider what's happening, again, economically at a global scale and within Canada specifically, we'll do well to put our money into real estate, manage it, treat it like a business, and you'll do exceptionally well. We'll see how the economy does, but it's not looking good. That's for darn sure, short of some of our Western provinces. Alberta is a prime example of that. So that's all for now. We'll see you next Rein It In, episode number 46. I know there's going to be some interesting things to talk about. Talk to you then. So if you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.